You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Tuesday. Today, kind of like ironic because I got this question a few times not too long ago, so I decided to do this podcast, and then I kept on getting that question. So definitely, there's something around here. So if you have been following my portfolio for a while, and of course that's not financial advice, but I just report whatever I do with my pension plan portfolio, and I'm pretty open about my investment strategy in the optic of like if I can inspire or try to help people getting like their own investment rules and invest with more conviction, well, therefore this podcast has achieved its purpose, its mission. So the way I manage my portfolio in terms of asset allocation is I always try to maintain a balance between 50% of my equities invested in Canadian stocks and the other 50% goes into US stocks. I like simple rules, and that's one of them. It's easy because whenever my portfolio goes like 60-40, I know that I have to sell for about 10% of the stocks that are like being overweight and then just put it back into that 50-50 just to maintain this balance. Could have decided to go 70-30, 60-40, of course. And that's not the point. The point is to like find something that you're comfortable with, that you like, that works, of course. And then you just maintain it. That's like the way it goes. But the question is, why in the world I do not have any international stocks? And I've been quite vocal about that. I'm not very interested in researching those anyway. So I purposely close the door to international stocks, like companies trading in Asia or trading in Europe that could be traded as ADRs on the New York Stock Exchange, for example. Very rare. I'm not against that, but very rare I'm going to go for this. It's kind of ironic, especially because, you know, I worked as a financial planner for like a good 10 years. And I mean, every single time that someone asked me, like, should you have like international exposure, I used to say, well, of course. I mean, it's really important to be diversified and to have exposure to international markets, right? So why in the world I'm not doing what I said, right? So let's bear with me a second. I have actually 3 good reasons explaining the strategy behind it and the reasoning. So let's get on with the first one. The first one is, what was true like 10, 15, 20 years ago is not as true today. In a sense where 20 years ago, when the market was doing well in Europe, maybe we had a recession in North America and vice versa, or same thing with in like emerging markets and so on. So having exposure to different countries meant that you could also ride good like economic like countries that are like in a good economic shape versus ones that are in recession. So that was like a way to diversify. Today, all the countries are pretty much interlinked, right? We all depend to each other. Maybe it's gonna change now. We have like a big commercial war, but before that, I mean, if there's a recession in China, there's a big chance we're gonna feel it, and vice versa. And it was not exactly the case 15, 20 years ago. So now that there's a lot more business being made across different countries, it's also making the diversification less important because in one way or another, you're still going to be in a recession or not. The second reason, and that's the most important one in my opinion, why I do not have international stocks is because I still have a lot of international exposure nonetheless. So see, I'm actually preaching exactly, I'm doing what I'm saying is, yes, it's important to have international exposure, but you don't have to invest in another country to have a business that is actually running and generating revenue out of another country. Just for fun, I looked at my top 10 holdings. That is like roughly 53-54% of my assets. And a lot of those companies are actually making money outside of North America. So for Apple, for example, we're talking about slightly over 50% of their revenue is not coming from North America. For Alimentation Couche-Tard, it's about 20-25%. For Costco is 14%. Microsoft, about 50%. Brookfield is investing all over the place. Constellation Software, it's about 40% as well. Visa, same thing, about like 50%. And then you have, like, of course, others like Waste Connection or National Bank that are not getting much exposure to international market. But you can see that across my portfolio, there are several companies and also smaller positions in my portfolio that are generating 30, 40, 50% of their revenue offshore. So therefore, I do have this exposure to international market. So yes, it is a little bit more subtle, not as obvious. And to be honest, I had to actually look into each of those companies in my top 10 to see really like what was the real percentage. Like I had a feeling that Apple and Microsoft was about 50% out of North America, but I didn't know for sure. So that was like more an impression. Now you do the research and just like, oh, okay, so that's exactly how much they're making. But long story short, I do have a lot of exposure. And when you think about that, like if I was going to go for like just pure play, just investing in Canada, just investing in the US, just investing in Europe, for example, I would probably not try to get like 40, 50% of my portfolio outside of North America. The reason is simple. The US market is the largest one in the world. So you want to have like a large exposure to this one because this is going to drive a lot of returns. And then, of course, as a Canadian, I have the Canadian bias, so it's only normal to have a good chunk of my portfolio in Canada. So the third one, the third reason. So the first reason is it's not as necessary as before. The second one is when I look at my investment overall, I do have probably an overall of like 20% or 25% of revenues that are coming anyways that will benefit from any driving countries outside of North America. So that's good. And then the third one is as as a stock investor, someone who reads financial statements, who has to do the studies and so on, instead of like going for an ETF, it is a lot more complicated. More complicated in the sense that sometimes like European companies, for example, do not have the same earnings seasons, and a lot of them reports twice a year instead of 4 times a year. So it creates kind of like a hole where I review my portfolio quarterly, but some companies I would not have much information about those. So that's like one thing that I don't like that much. The second thing is the currency exposure. Of course, it's just adding another level of fluctuation in the portfolio. But most importantly is when I look at a graph for the dividend, for example. Well, I most of the time, if I look from like a North American based platform, they will provide me the numbers, but like translated in USD, for example. So then I see that the graph is not always going up. It's like there are variation, but they are not coming from the business dividend growth policy, but rather just the currency fluctuating. So then I have to go into the company's website to look at their distribution history to see if they were increasing the dividend or not, if it's paid in euro, dollars, or any other currencies. So I just don't like to get that additional layer of complexity, and it just take more time. So it's not that complex, but it's kind of like just having sands in your wheel. It's not running properly. Tax complication, of course. You have to consider like tax implication of investing in foreign companies. And again, yes, once you know about it, it's done. You can set it up, but it's once more time, a little bit more time, a little bit more complex. So for all that extra work, am I getting something in return? Like, is there no equivalent? So if I find an amazing company, like a utility business in Spain, maybe I can find an amazing utility in North America, and that will be just great. And I will not improve my portfolio by that much by selecting another one. So long story short, I just focus on North American stocks, mostly out of like convenience. It's convenient. It gives me a great diversification. It's not going to change my returns that much anyway. And because I have a lot of companies doing business outside of North America, I don't see the purpose. I'm not against it, just to be clear. Like if you want to have like a specific exposure to international market, I would say it's fine. I would say it totally makes sense as well. I'm just explaining what I'm doing and why I'm doing it. I don't think I have like the sole answer on that question, but it's just like one opinion that is being explained over that 10-minute podcast. So there you go. Quick announcement. We will be reopening the doors to Retirement Loop. We have almost 500 retirees there sharing their tips, learning together, and building their retirement plan, adjusting it throughout every year. And it's just like a really good tool for you if you do not want to spend like $3,000 on a financial plan, meet with 3-4 financial advisor, not making sure that you can trust them. Well, we can teach you how to build your own retirement plan and retire with conviction. So if you are interested in knowing more about Retirement Loop, you can sign up for the free waitlist at moosemarkets.com/retirement. moosemarkets.com/retirement. We are going to reopen the doors of Retirement Loop at the end of May, so you're going to get more information if you subscribe to the waitlist right now. All right, Moose, that's enough for today. Tomorrow, we are going to talk about, is there an equivalent to SCHD in Canada, a very popular US dividend growth ETF? So let's do some digging. We're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.